It's good to see you again. This is my third meeting with you all. And thank you for joining me and my leadership team for our second quarter results of the financial year 2024-25. In quarter two, we met our expectations for revenue, bookings, and margins. The long-term potential of our business is strong, and we are prepared to handle the current economic uncertainties that all of us see. We continue to focus on our 5 strategic priorities and building a strong talent pool to capture AI opportunities. Now, let me go over the financial highlights for the quarter and share some insights on our markets and industry sectors. By the way, all the revenue growth numbers I share will be in constant currency. Our IT services revenue for quarter two was 2.66 billion, reflecting a sequential growth of 0.6%. This brings us closer to the upper end of our guidance. Our operating margin came in at 16.8%, which is an expansion of 35 basis points quarter on quarter and 71 basis points year on year. And in terms of total bookings, we ended the quarter at 3.6 billion, which is an increase of 8.4% quarter on quarter. Our Capco business continued to see traction, and it grew 3.2% quarter on quarter and 6.9% year on year. Now, coming to our strategic market unit performance, we saw sequential growth in 3 of the 4 markets in quarter two. Americas 1 achieved a sequential growth of 1.2%, driven by good performance in healthcare, technology, and communication sectors. Americas 2 also recorded sequential growth of 0.8%, supported by robust demand and strong execution in BFSI sector. APMEA grew by 0.3%, driven by traction in Capco. And we are seeing early signs of this business stabilizing. Europe registered a sequential decline of 0.1% due to overall weak demand and some client-specific issues in few accounts. Among industry sectors, we experienced varied performance. Let me start with Capco. With a strong account mining and traction in Capco business, BFSI continued to accelerate, delivering 2.7% sequential growth. This growth was led by Americas. And additionally, we are seeing momentum in both APMEA and Europe. This clearly marks the 3rd consecutive quarter of growth in BFSI. Technology and communications grew by 1.6% sequentially, driven by the ramp-up of a recent large deal and momentum in existing relationships. However, manufacturing remained soft for us, with a sequential decline of 2%. We are seeing good progress with our consulting-led industry solutions, specifically in the automotive manufacturing segment. And in addition, there are also signs of uptick in demand in the industrial segment. We will focus on converting this into wins to revive growth in manufacturing. Energy and utilities also remained weak, with a sequential decline of 3.7%. However, we see opportunities for us in vendor consolidation on cost takeout, particularly in the energy sector. As you all remember, from the last 2 quarters, we identified 5 strategic priority areas for growth. We have advanced in all 5 areas, and I'd like to take this opportunity to share some indicators of our progress in quarter two. 1, we stayed focused on growing our large accounts in our 4 profitable markets and 6 priority sectors, and we will continue to invest in them for expansion and growth. In quarter two, our top account grew 4% sequentially, top 5 accounts grew 6.2% sequentially, and top 10 accounts grew 3.7% sequentially, reflecting our focus on expanding our footprint and scaling our large accounts. Large deals, of course, are crucial for our growth. During the quarter, we booked 19 large deals with a TCV of 1.489 million, or which is close to 1.5 billion. This translates to a growth of 29% sequentially and 16.8% on a year-on-year basis. It's encouraging to see the diversity in our large wins across sectors. In fact, the deals we have won cover a variety of themes, from cost reduction and vendor consolidation to application modernization and cloud operations. In fact, we are leading these deals with industry and cross-industry solutions, which are consulting-led and AI-powered. Let me briefly talk about the two large deals that we won in quarter two. One, a leading transportation and logistics company has selected Wipro to drive a business-critical SAP S/4 HANA transformation program. In fact, this win involved collaboration between all our consulting arms, Rising, Designit, and Capco. In fact, it highlights our industry knowledge and our ability to deliver customized solutions to our clients. In the second example, a software technology company has selected us to support its product development and IT operations end to end. This is a total outsourcing deal where Wipro will consolidate vendors, take over engineering, applications, infrastructure, and operations for this client. Additionally, we will implement GenAI-powered solution to solve their business challenges and deliver operational efficiencies.
Thank you, Srini. Good evening, ladies and gentlemen. Let me share a quick update on our financial performance for the quarter before we open it up for Q&A. On the IT services revenue for Q2, we deliver a sequential growth of 1.3% QOQ in reported currency terms and a growth of 0.6% in constant currency terms. This is closer to the upper end of the guidance range that we had laid out last quarter. We are pleased to share that our operating margin for the quarter was at 16.8%, an expansion of 35 basis points quarter on quarter and an expansion of 71 basis points year on year. This brings us one step closer to the band that we had laid out a few quarters ago of 17 to 17.5%. This expansion in margins was achieved on the back of operational improvements and after absorbing 1 month of salary increases for our associates that we rolled out in September. This was done within 9 months of our earlier increase. We begin Q3 with headwinds of furlough and fewer working days that Srini alluded to. Yet, we remain confident of holding our margins in a narrow band. Our net income grew 21.3% year on year on the back of higher operating profits, which grew 11.4% year on year. Our EPS at rupees 6.14 grew 6.8% sequentially. Q2 was yet another quarter of very strong cash flows. Our operating cash flows of nearly $510 million in Q2 is at 132.3% of our net income. With this, we've added cumulatively nearly $1 billion in the first half of this financial year. At the end of Q2 25, our investments and cash balance on our balance sheet stands at $6.2 billion. Let me cover some other key matrices. Our other income, net of the finance expenses, grew by 34.2% sequential. Our accounting yield of the average investments held in India was at 7.9%, and the growth in other income was also because of higher investable surplus. Our ETR for Q2 is at 24.6% versus 24% in the last quarter. Our hedges continue, versus 24% in Q4 of 24. It was 24.5% last quarter. Our hedges continue to be in line with our policy. We had about $2.8 billion of foreign exchange derivative contracts as hedges at the end of Q2. Finally, before I move to guidance, I would like to share with you that in our recently concluded board meeting, the board of directors have recommended an issue of bonus shares in the ratio of 1:1, which is subject to the shareholders' approval. Additionally, we are working through a revised capital allocation policy in line with our strategy, and hopefully we'll be able to share it with all of you the next time we meet after our January board